some stocks may not move, but JVL is certainly a stock that is moving. It's trading with gains of almost 20%, returns of over 100% in the last 1 year as well. What been the key factors at play for the business to do well, because of which people might be looking to go out and buy the stock as well? Let's get in Adarsh Jhunjhunwala, whole-time director of the company. He joins us right now on the phone line. Good having you. Thanks much for joining in. Can you tell us a bit more about JVL Agro? Because we do know that the company is engaged in the manufacturing of vegetable oils and fats, vanaspati, refined oil, etc. Is that the primary nature of the business, and how is business doing for the last 6 odd months?
Hi, thank you very much for having us over, and thank you very much for providing this opportunity. JVL Agro, actually, this what you mentioned is a refined oil and vegetable fat. This is the dated information. JVL Agro has started to transform itself into a brand-based food company since the last 2 to 3 years. And as on date today, if it is selling about 3,500 crore of food products every year, 95% of that is only and only under a brand, through the sales and distribution network that the company has created for itself. So, though, yes, the major products that it sells are vegetable oil, but as I mentioned, it is a brand-based food company, which is the target for the company for the next 2 to 5 years. Along with the vegetable oil, the company moved itself into rice, a premium quality non-basmati rice, because India is a huge consuming market for a product like rice, and we felt that there is no brand available in the market in the non-basmati segment. The basmati segment is pretty crowded, but the non-basmati segment has nothing. We have also started to get into pulses. Branded pulses is another segment which is being left untouched by a lot of other companies. So that's another opportunity that we have started to focus and work on. So as I said, over the next 2 to 3 years, you will gradually notice that the company has transformed itself into a high-value branded food company, and that is the outlook for the company. And I'm glad that the market is realizing it is not a commodity company anymore. It's a brand-based company.
Mr. Jhunjhunwala, well, the going's been really good for the stock price of your company, but I'm just looking at the financials. The first half, the picture is not looking that great. Your profits in the first half are down to 11 crores versus 21, which was seen in the corresponding quarter. Also, I can see the finance cost is pretty high. If you could tell us what's the current picture, how's the second half looking, and also if you could just tell us what's the total debt that is there on the books?
So, well, as far as the long-term debt of the company is concerned, the company has only 60 crore of long-term debt on an asset block of about 500 crores. So the company is very thinly indebted in terms of the long-term debt. The rest of the debt that the company has is basically working capital debt. Now, when the business model of the company is being transformed, there is a bit of a reorganization being done on the debt side of the company as well. So you will see a bit of a hiccup here and there, but all of that in the long run is going to pay off very, very nicely for anybody who believes in the company and the story of the company as in day to day.
So could you clarify? I mean, one, when will these temporary hiccups move out of the way? How would FY18 as a year look like, and how could FY19 look like?
So, well, there could be a bit of a shrinkage in the top line. As I said, the company has started to completely take itself off the commodity business and started to focus on the brand building. So there is going to be some bit of a hiccup in terms of the top line, and there could be some glitch in the bottom line as well. But over the next 2 to 5 years, if the outlook is, if there is somebody who invests for the long term, they'll definitely see some great results coming out of the company.
No, which is a fair point, Adarsh, but just wondering, how would revenues look like? One is investing, one is what the numbers will look like. So let's assume there is a bit of a downtick that comes in FY18, and I heard you mention that over the next 2 to 5 years, things will look good. What are the internal targets about what quantum of growth rates could happen on the top line as a result of the reorganization you're doing?
In the next 2 to 3 years, the company is targeting a top line of at least 6,000 crore, because the facilities or the capacities that the company has can easily take it up to a top line of 6,000 crore. We don't need to add any facilities for that. So 6,000 crore is definitely doable. Post that, along with that, the company is also, as I said, is moving aggressively into rice. In the last 2 years, our experience in rice has been quite fantastic. We got into a bit of a pulses business in the last 3 to 4 months, and we have had excellent results so far. The market feedback has also been very, very positive. So I can just tell you that 6,000 crore of a top line in the next 2 to 3 years is definitely doable for the company.
By entering into these new segments like rice or pulses, which you just mentioned, will that help your margins? Because you're operating in an industry where margins are pretty low. I can see in the last few years your margins have just been in the range of 1.5 to 2.5%.
Well, as far as the net profit margin on the top line is concerned, yes, you may point out that the margins have been a bit thin. But going forward, as the company goes into more and more high-value branded items, the margins are definitely going to see an upside. Moreover, this is fundamentally an industry which is a low investment, high turnover business. So if you were to look at a return on capital employed, you will...
So if I could ask you, what are the current EBITDA margins?
The current EBITDA margins as on date today would be about 3 to 4%.
3 to 4%. And what's the target by the end of this year and also for FY19?
Well, this year, as I mentioned, FY18 could be a bit of a blip because the company is going through a bit of a reorganization internally.
Okay.
18-19, we could definitely see the margins improving anywhere between 3 to 5%.
And just last question from my side. You said 60 crore is your long-term debt. What is the cash that the company is sitting on?
The company would have cash reserves. I will have to check on the exact number on that, but long-term debt of 60 crore is something I'm quite certain about.
Okay, one final question. So if indeed you manage to do in 6,000 odd crores by, say, in the next 2 or 3 years, and that's the target that you mentioned, I would presume that the bottom line growth would be higher than proportionate simply because,
for sure,
as you mentioned, you will get into the higher margin segment as well.
For sure, for sure.
And you won't require,
yeah.
Any funds for the same.
We don't need any long-term debt for the same. We will definitely need help from our existing financial institutions as far as working capital is concerned. But as far as long-term debt is concerned, nothing.